What's up, traders? Welcome back to Business Talk with Billy Bands. Today we're going to be discussing candlestick patterns, their meanings, and examples. Before we jump right into it, go ahead and follow me on Instagram at Billy Talks Business for more content and tutorials and tips. So let's jump to the next screen. So we're going to be discussing bullish candlestick patterns first. So this bullish candlestick pattern is called a hammer. The hammer is a short body with a long lower wick and is found at the bottom of a downtrend. A hammer shows that there was selling pressure during the day. A strong buying pressure drove the price back up. The color of the body can vary, but the green hammers indicate a stronger bull market than red hammers. So let me explain to you this. Obviously, it looks like a hammer, and when you see this bullish candlestick, the potential direction could be up. Now, just because I explain what these candlesticks mean doesn't mean that every single time you see it, it's going to play out to its meaning, right? It just gives you an idea of where it's more likely to go. So as you can see, we have the lower wick of the buying pressure, and we have the buyers that are standing strong at the top. So we have the open here and the close up top. So if we look here at the ascending triangle, actually a symmetrical triangle, we're going to get into this in later videos, but when you see a hammer form near a support, that is very bullish. You want to take that trade and set your stop loss right below it. So let's jump to the next candlestick. That's the inverse hammer. It's a similar bullish pattern, which is the inverted hammer, the only difference being that the upper wick is long while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. So when we see the inverted hammer, this is a bullish pattern indicating that the bulls are standing strong at support and there is selling pressure trying to drive the price down, but the bulls are standing strong, which are the buyers, and they're not allowing price to drive lower. So they're standing their ground. Oh, go back. Oh, where we go? Hold on. But they're standing their ground, right? Now, on the other hand, we have the shooting star, but we're going to get into that in a couple more slides. So don't worry about the shooting star right now. But just a little background on it, the shooting star forms at the top of an uptrend and usually indicates a trend reversal to the downside, which it did. The inverted hammer, which we're talking about now, forms at the bottom of a downtrend and indicates an uptrend reversal, which we see here. Let's go to the next slide, which is a bullish engulfing pattern. The bullish engulfing pattern is made of two candlesticks. The first candle is a short red body that is completely engulfed by a larger green candle. Though the second day opens lower than the first, the bullish market pushes the price up. Now, what does that mean? So we can see the first candle is the short red body that's completely engulfed by the green candle, right? So if it depends what time frame we're looking at it on, because we could see these candlesticks in the 1 minute, the 5 minute, the 10 minute, the 15 minute, the 1 hour, the 2 hour, the 1 week, the 1 year, whatever it is, right? So if we're having a longer term perspective and we're looking to really go super long and we're looking to swing trade for about a week, 2 weeks, a month, whatever it is, we're going to be looking at the weekly chart for this. So in my opinion to you guys is that when you're looking at candlesticks on a longer time frame, they're more significant than if you're looking at them on an intraday chart. So with the bullish engulfing pattern, the potential direction is up, right? So as I just showed you, it's comprised of the opening price at the top, closing price at the bottom. When we see the bullish candle, it must gap a little bit lower because it's the engulfing candle, right? We see this gap lower, and the bullish candle opened at or lower than the previous candle's close. So the candle closed here, the bearish one, and the bullish candle opened up a little bit below, which is what we're looking for. The length of the bullish candle engulfs the previous red candle. See how it's bigger than the red candle? It engulfs it. The bullish candle closes above the previous candle's open, which is here, closes way above it. So now let's look at an example over here. After we had the downtrend, boom, we shot down. Now, we formed at the bottom of the downtrend, which indicated a trend reversal to the upside, which happened. So we could see small red body, engulfing green candle, then next candle opened up above it, and the trend continued. So what I would have done here is I would have taken the trade about this point right here and set my stop loss right below this candle here. Because if everything should go as planned and it is a trend reversal to the upside, I want to take advantage and make profits on this rally up. But on the other hand, if it was a fake out and this candle didn't necessarily mean what it was supposed to, I want to protect myself and set my stop loss right below here. So now let's move on to the next candlestick pattern, the piercing line. The piercing line is also a two-stick pattern made up of a long red candle followed by a long green candle. There is usually a significant gap down between the first candlestick's closing price and the green candlestick's opening. It indicates a strong buying pressure as the price is pushed up to or above the mid price of the previous day. So now what does that mean? It sounds a little confusing, right? So let's look right here at the piercing line. It's a two candles pattern, right? 1, 2. And it's a trend reversal pattern. So this forms usually at a downtrend, right? We're not only going to see it at a downtrend, but that's where it holds the most significant value, right? So it's effective if found during a downtrend. The first candle has to be red and bearish. The second candle has to be green. But both candles should be big green candle that opens below the red candle. The green candle has to close slightly below the top of the red candle. So now, what does that mean? Let's look here. We have the candle that opened up here, closed lower. Then we have the green candle that gapped down, right? So, which opened up here, rallied up, closed above the midpoint of the red candle. It pierced through and closed here. Then over here would have been a buy area because we would buy here. The green candle, the piercing line pattern is confirmation that the stock is on an uptrend. You could take a position here and you could set your stop loss right below here. Stop loss is very important. If the price comes below the low of the green candle, you should sell it immediately because that means that the piercing line pattern did not hold its significant value as it should have. So now let's move on to the next pattern, the morning star. I actually like trading the morning star a lot because I find a lot of significance in this pattern. So the morning star is considered a sign of hope in a downtrend. It is a three-stick pattern, one short-bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the selling pressure of the first day is weakening and an uptrend could be near. Now, I say pressure on the first day because in these examples, I'm pretending like each of these candles represent a day. Now, they don't have to. They could represent 1 minute. They could represent 5 minutes, 20 minutes, 30 minutes, whatever time frame it is. Just to be easier, I'm going to represent them on 1 day. So, the Morningstar candlestick pattern consists of 3 candlesticks. The real body of the second candlestick, which is here, develops in the lower shadow of the first candlestick. So we see we have the first candlestick here, and we have the shadow right here, right? This body must form within the shadow. It cannot form in the real body. It must form in the shadow. Then the real body of the third candle does not touch the real body of the second candle, which is here. See how it doesn't touch it? It doesn't come near it. It's not equal to it. It's above it, right? If there was another wick here, this would be forming in the body. In the shadow. When the second candlestick is a doji candlestick, the pattern is called a Morningstar doji. But we don't have to worry about that for this example. But this is how the Morningstar is formed, right? And which occurs at support during a downtrend. So at the bottom of a downtrend, you'll normally see a morning star. At the top of an uptrend, the peak of an uptrend, you'll see the evening star. We're going to get into that in a couple more slides. But this is basically the inverse of the morning star. You could think of the morning star as the sun rises in the morning. Think of this as the sun, the middle candle as the sun rises in the morning, and the evening star sets at nighttime, right? Goes down. So that means price is going to be going down. Now, the names of the candles aren't necessarily important, but you must know the meanings of them, right? Because the names aren't going to help you make money, but the meanings will. So let's move on. The three white soldiers, very, very, very important pattern. It's actually probably one of the most common patterns that show up. And this occurs at a downtrend, at the end of a downtrend, and normally signals a downtrend reversal to the upside. So the three white soldier pattern occurs over 3 days. It consists of consecutive long green candles with wicks, which open and close higher than the previous day. It is a very strong bullish signal that occurs after a downtrend and shows a steady advance of buying pressure. So as we can see, we had the downtrend, boom. Let's say we found support here. Now, after we found support, boom, we have our first green candle, which is our first green soldier. In this case, we'll call it white soldier. Our white soldier, then, boom, opens at the top of the close. Have our second soldier and our third soldier. This means that the potential direction is up, indicates very strong buying pressure. So as we can see on the chart, boom, price fell off, found support, let's say, right here, and then we formed our three white soldiers. Now, the wicks don't necessarily matter as much if it's, let's say we formed two candles, right? Two green candles, but this candle didn't have this lower wick. It just had this top wick. Now, that's not a good sign. That could mean that there's a fake out and it's going to continue to head lower until it finds support. So we only want to take this trade if it's confirmed on the third candle that it's a three white soldiers pattern, which gives us a better probability of it heading in our favor. So let's move on to the next slide. The Bullish Harami. The Bullish Harami is a bullish reversal pattern that's made of two candlesticks. The first candle would be a red candle, while the second candle would be a green candle with a small body. The second candle of the Bullish Harami pattern would be completely within the range of the body of the first candle. Now, this is a fairly simple candlestick pattern to recognize. As you can see, we have the red candle, right? A longer red candle. The wicks don't necessarily matter, but we have the longer red candle, and then we have a green candle that's forming within the range of this. So if this green candle exceeds out of the close or the open, then this isn't a bullish Harami, right? There's no significance with it. But if it forms in this sense, this is a bullish Harami. And you will normally see this at the bottom of a downtrend where it finds support. So let's look at a little example. The bullish Harami right here. We're traveling on a downtrend, boom, boom, boom. We found support. Now we have that long red candle, this small green candle that forms in the center of the body of the red candle. And if we would like to take this trade, we would buy just above the high when the next candle is forming. Then we'd set a stop loss just below the low. So in case we do get faked out, it's okay because we anticipated that anything can happen in the market. And the bearish Harami is just the inverse of the bullish Harami that occurs after an uptrend at the peak. You would do the same thing. You would sell short here, place your stop loss above, and same technique, vice versa. So now we went over the bullish candlestick patterns. Bearish, messed that up. Bullish candlestick patterns form during an uptrend when the buyers are stronger than the sellers. The wick and size of the candle body show who has more control. So we have the most bullish candle, the second most bullish candle, normal bullish candle, neutral bullish candle, and the least bullish candle, right? Because we have selling pressure, right? That's why this is least bullish, because the selling pressure is coming in. This is neutral because we have the sellers and the buyers, and they're virtually at the same price point, right? The open and the close. There's really no one taking control here. And here, I would say the same thing. We're bullish, but we're not really very bullish. We're not under bullish. I would say this is more of a neutral candle as well, but we could say confidently that the buyers have more control in this candle than it does in the neutral candlestick pattern. Now, this is the second most bullish, simply because we could see that buyers push the price up and there's no sellers. There's no wick on top, so there's no sellers trying to push the price down. The bulls have the most control here. Now, this is the most bullish candle because we could see that there's no shadows. So there's no sellers. There's no sellers trying to take over. We're simply just bullish here. There's a lot of buyers that have the most control. So for bearish candlestick patterns that we're going to be going over now, um, bearish candlestick patterns form during a downtrend when the sellers are stronger than the buyers. The wick and size of the candle body show who has more control. So again, same concept go for here. This is least bearish because the buyers are stepping in, pushing the price up. This is neutrally bearish because there's equal strength between buyers and sellers. Normally bearish. This is the second most bearish because the sellers are pushing the price down, right? And this is the most bearish, which means the sellers have the most control in this candle. So now let's look at some of the bearish candles. Sorry. So we have the hanging man candle. The hanging man is the bearish equivalent of a hammer. It has the same shape but forms at the end of an uptrend. It indicates that there was a significant sell-off during the day, but the buyers were able to push the price up again. The large sell-off is often seen as an indication that the bulls are losing control of the market. So let's look at an example. So as we can see, it looks like we have a head here and we have the hanging man. Of course, this does look like the hammer, but if this forms if this forms at the top of a downtrend, yes, at the top of an uptrend, I'm getting confused looking at both of them. If the hanging man forms at an uptrend, that is a sell signal because that shows that there is bearish implications in this candle. If we went back to the first example of the hammer and it forms at the bottom of a downtrend, that is a bullish signal to buy. So if we see this hanging man form at the top of an uptrend, that is an indication to sell and go short, right? So let's take a look at the next example. The shooting star. So the shooting star is actually another very important candle that's actually very common along with the three white soldiers. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. It has a small lower body and a long upper wick. Usually the market will gap slightly higher on opening and rally to an intraday high before closing at a price just above the open, like a star falling to the ground. So think about it. We have you could think of it after the uptrend, boom, we have the uptrend. Think of it like a star, right? Boom, star. And guess what? The sellers are pushing it down, but the buyers are trying to stay strong here. They're trying, right? But sellers were strong enough because this formed at the top of an uptrend. Price came down. So these are the components that make up the shooting star. We have the high and the high of the long upper shadow. We have the close, the open, the close. There's little to no upper shadow at the bottom, right? If there's a longer shadow, then that would be like a spinning top, right? Which we're going to get into in the next couple slides. So if you see the shooting star, I suggest you go short after confirmation of the next candle. Let's get to slide number 12. The bearish engulfing pattern. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small green body that is engulfed by a long red candle. It signifies a peak or slowdown of price movement and is a sign that a downtrend is near. The lower the second candle goes, the more significant the trend is likely to be. So let's explain that. We have the smaller bullish candle. So the first candle has a small green body that is engulfed, right? It gets eaten up by a long red candle. So the small green candle gets eaten up by that long red candle, and it signifies that the peak is here, right? Or near. And once we see this, the confirmation would be after this next bearish candle opens up, equal or lower to the close of that previous red candle, which is here, right? And the potential direction is down. So when we look at the chart, we see that the bearish engulfing pattern forms here with the small green candle, the engulfing red candle. So what we would do after this candle forms, the confirmation candle, we would sell short, and then we place our stop loss right above so we don't get faked out, just in case this is a little pullback instead of a reversal, right? And then if we look at the hammer reversal that we went over before, that occurs at the bottom of a downtrend, which is a bullish pattern. You see, boom, buyers stepped in, pushed the price up, found support, then pushed up. These would be called spinning tops. We're going to get into this in the next couple slides, but let me go over this. So for the bearish engulfing, I'm going to reiterate it one more time. We have the close and the open on that small green candle. Then we have on the bearish candle opens at or above the previous candle's close, right? Right here, the previous candle's closed here. It opens up a little bit above it. The length of the bearish candle engulfs the previous green candle. See how it engulfs it? It just eats up the candle. The bearish candle closes below the previous candle's close. So, So basically it closed below the previous candle's close, which is what we needed. Let's move on to the next one. The evening star. The evening star is a 3 candlestick pattern that is equivalent of the bullish morning star. It is formed of a short candle sandwiched between a long green candle and a large red candlestick. It indicates the reversal of an uptrend and is particularly strong when the third candle erases the gains of the first candle. So, like I said, let's look at this chart. We have the uptrend forming because this forms at the end of an uptrend, right? So 1, we have the uptrend. 2, we have the bullish candle. 3, we have that little gap up. You see that gap up? How it didn't open exactly on it? It opened up a little higher. So we have that gap up. 4, we have the small bullish and bearish candle. This could be bullish, could be bearish, could be red, it could be green. Doesn't matter as long as this specific candle is forming, right? Then 5, we have the gap down, and 6 is the confirmation, which is the bearish candle. If we see this means that there is going to be a reversal to the downside. So you could think of the evening star as pretty much what it is, a star, right? It looks like a star that sets in the evening at the top, and it's coming down, right? The sun goes down at night and comes up in the morning, such as the morning star pattern, right? This is the bullish pattern. So we have the morning star, right? The sun comes up in the morning. So it formed at the bottom of the downtrend. And what happened? Boom, it went up and up. So proves right. Let's go to the next one. The 3 black crows. The 3 black crows is an inverse of the 3 white soldiers, right? So the 3 black crows candlestick pattern is made up of 3 consecutive long candlesticks with short or non-existent wicks. Each candle opens at a similar price to the previous candle, but selling pressure pushes the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downtrend as the sellers have taken over the buyers. So we can see uptrend formed, then boom, engulfed it a little bit, then closed lower, closed lower, closed lower, and then finally we had this little inverse hammer form, boom, potential direction went down. But if we also look, it's supposed to be here. If we look here, we had the shooting star, which was bearish, right? The shooting star, as we went over before, led into a downtrend, which formed the 3 black crows. So the shooting star indicates that a bearish reversal is on the way, right? And then what was the next candles that formed? The 3 black crows. As we could see, 1, 2, 3. tried pushing back up, but it couldn't. Boom, we had the downtrend. So this is actually also a very common pattern that's extremely important. The dark cloud cover. The dark cloud cover indicates a bearish reversal. It has two candlesticks, which is a red candlestick that opens above the previous green body and closes below its midpoint. It signals that the bears have taken over, pushing the price lower. If the wicks of the candles are short, it means the sellers dominated and came in strong, especially on high volume. So let's break down the components of the dark cloud cover. On the first green candle, we have the highest price of the day at the wick. We have the closing price, the opening price, and the lowest price of the day. Then what we have is the red candle and the green confirmation candle. So let's take a look. At 1, we need the uptrend, right? Because it forms at the top of an uptrend. 2, we needed that bullish candle, right? As we see here. 3, we needed that gap up candle, as you'll see here, gapped up. 4, we need that bearish candle coming down that's closing at least 50%. I'm sorry, yeah, at least that closes below 50% of the previous day's bullish candle. So you see this bullish candle? This candle, number 4, has to close at least 50% below this green candle. So if we were looking at the 50%, it'd be around here in the middle. But we closed at least a little bit below the 50% mark. 5, closed below 50% of the previous day's bullish candle, exactly as I said. So the dark cloud cover, as I just explained, the 50% line would be about here. As long as it closes a little bit below that, that's what we need. And then we need this 4th candle. We don't need the candle, but this 4th red candle is a confirmation that price is heading lower. And for the final pattern, we have the spinning top. The spinning top has a short body centered between wicks of equal length. The pattern indicates indecision in the market. Spinning tops act as a period of consolidation or rest, where price moves sideways following a significant uptrend or downtrend. On its own, the spinning top is a relatively neutral pattern, right? So a spinning top isn't necessarily bullish or bearish. It could be both. The potential direction could be up or down. So as we can see on an example chart here, we're really just moving sideways with a spinning top. It's basically just we have the buying pressure, selling pressure, and a congestion area where there's an indecision in the market where the buyers and sellers can't come to an agreement on which direction price is going to go, and they can't overtake each other, right? So as we can see here, price is just moving sideways. It's going a little bit up, but it's not really going anywhere. It's not going anywhere. So see, look, it comes up a little bit, comes back down a little bit, comes back up a little bit, until finally, boom, it breaks off and it goes to the downtrend. So, guys, I hope you enjoyed the video, and I hope you can use that in your next trading session. Everybody have a blessed week. Take care and have a great day. Don't forget to subscribe, turn on that post notifications, and give me a follow on both of my Instagrams at Billy Talks Business and at K Capital. Everybody have a blessed day and take care.